Ladies and gentlemen, welcome back to PwC's Risk and Regulation news channel, and welcome back to our special video series on securitizations. Today, for the first time, we will change our view a little bit. Before, we were speaking mostly about the perspective of the banks, and today we will change our perspective. We look to securitizations from the perspective from insurers. And like always, I'm not doing this alone. I have a wonderful expert today with me, Melanie. She's the director from our PwC office in Stuttgart, and she's our expert on risk and regulation for insurance companies. Hi, Melanie. How are you?
Hi, Martin.
Great to have you here.
Very happy to be here today with you.
Melanie, insurers and securitization. What is it about? Why are securitizations important for insurance companies?
Yes, first of all, and the general idea about the whole securitization initiative, and we have already learned about this in the previous videos, of course, is to make the EU securitization market work more efficiently as a funding source for the real economy. So, and for this, obviously, you need the large investors on board. And looking at the insurers, these are the biggest investors in Europe, and we will look about this closer to at this today.
So, Melanie, what is so important about insurers and reinsurers as potential investors in securitization positions?
Yes, very good question, and let's start with this. The European insurance industry is a truly substantial investor. Just looking at Germany here, our home base, and one of the largest markets in Europe, German primary insurers managed about 1.6 trillion euros in assets as of last year, and this makes them the largest institutional investors in Germany. For the whole EU, it's about 9.6 trillion. And what you also see here on the slide, just looking at this huge number, the portion of securitization investments is very, very small. Mm-hmm. So it's just below 1% in the German market alone, but it's a similar and even lower range for the whole EU market. I think it's only Germany, France, and Spain overall that invest in securitizations at all. And German insurers or European insurers, they are very reluctant to invest in securitizations. They are traditionally very risk averse, and there's a huge lack of understanding about how the instrument work. And they have a bad image based on the financial crisis. And what is also important, they have still high solvency capital requirements. And this is what we will look at closer today. And maybe one thing more I forgot to mention here. When you look at the US market, for example, it's a totally different story. So they have about 17% in securitization. So I think there's a potential that can be used in the EU market.
Great. That sounds impressive, Melanie. Insurers and reinsurers are definitely very important investors for securitization positions. But what is the plan of the regulators to make this even more attractive?
Yes, the key development, and we have learned already about the securitization regulation and how this will reduce operational costs for originators and issuers. So now the key development for insurers is the draft amendment to the Solvency II Delegated Regulation, which just recently flow into the Solvency II review. And this comes with a proposal to reduce capital requirements for insurers.
Oh, that's the most interesting part. So when we look to the Solvency II Delegated Act or Delegated Regulation, what are the changes? What are the major changes to make securitizations more attractive?
Yeah, to facilitate investments and also unlock the diversification potential for insurers. Basically, there are two big steps targeting the risk capital under the standard formula, which is the default way to calculate capital requirements in insurance. Two big steps. First, the risk factors for senior STS securitizations will be aligned more closely with those of covered bonds or corporates, which already benefit from lower capital requirements. And remember, STS means simple, transparent, and standardized. So it's something that should be, insurers should look at because it's more risk averse. Yeah? And then second, for the first time now, non-STS securitizations will also be split into senior and non-senior tranches with lower factors for both. And this makes, obviously, capital requirements more risk sensitive and reduces unnecessary capital charges.
Oh, that sounds really good. In our previous videos, we were talking a lot about the capital requirements for banks when they invest into securitization positions. Now, of course, the focus on insurance companies. Similar to the CRR rules, would you say that the Solvency II regulation changes lead to lower capital requirements for insurance companies and therefore increase the investment potential?
Yep. Mm-hmm. Absolutely. And let's look at it closer. So the new treatment for senior tranches of STS securitizations first. This is designed to align them more with the prudential treatment of covered bonds, for example, as I already mentioned. And you see here, there are lower risk charges, stress factors over the whole, over all the durations and over all credit quality steps. So in total, we can expect a relief of about 25% in capital charges for these investments.
Yeah, significant change, definitely.
And here you see it in a very simple picture. The upper line is how it is currently, and this will be aligned more closely with the lowest line here, which is the risk charges per duration for covered bonds. So exactly what I mentioned. For senior STS tranches, we will have a relief here of about 1/4. For non-senior STS securitizations, it will be the same, basically, but even with a higher relief of about 1/3, minus 33%. So looks very impressive. Sorry.
Yeah, definitely. Melanie, you were speaking now a lot about the SUS securitization transactions, or that fulfill the definition of STS. What about non-STS securitization? Are there also changes?
Very good question. And as I already briefly mentioned, there will be also a change for non-STS securitizations. And you see here, for the first time, this will also be split into senior and non-senior. And we see here very nice in this table that for both senior and non-senior, the charges will be significantly lowered. So also in this respect, we will have a relief.
Wow, that sounds really good, Melanie. A lot of changes, of course, and it seems like that it makes securitization more attractive for insurers and reinsurers. Looking more to the practical implications, do you believe that this really will lead to a higher appetite into securitization investments by insurance companies and reinsurers?
Certainly, yes. And there are several reasons. We have pictured them here on the left side. First, you will benefit from higher diversification into asset classes like mortgages or consumer loans. There's a potential for higher yields, obviously. You have strong risk management with senior tranches, especially more strategic allocation flexibility, and better alignment with global peers. Remember, I talked about the US market, so this can be very attractive. And in today's inflationary environment, securitizations can really offer an attractive extra return. But of course, you need to really understand the product, and I think this is one thing that is still lacking in some parts of the insurance market.
I can imagine that. Okay, so you say it will definitely become more attractive for insurers and reinsurers to invest in securitization positions. That means that not only the volume will increase, but also a lot of insurers and reinsurers will invest for the first time into securitization positions. So what are the challenges and how insurers should prepare for these kind of investments and how we can support them?
Yes, of course, we can support our clients, our insurance clients with this, because as I mentioned, you definitely have to understand the product. There is a careful and comprehensive due diligence process obviously needed, structural analysis, risk modeling and Solvency II capital calculation, just what we looked at some slides before. You have to understand how it works and then see how it can fit into your overall Solvency II capital and especially diversify. And of course, you have reporting requirements that we can help with. You have to integrate it in your portfolio management, in your SAA, ALM, etc. And of course, there's a whole governance process required behind it, training, knowledge development. But I believe once you have done everything on this end, then you really can benefit from this.
Impressive, impressive. Thank you very much, Melanie, for being for the first time here on this Risk and Regulation News channel, and thank you very much for taking over the perspective of insurance companies for the first time. That was really great. And ladies and gentlemen, if you have any further questions regarding securitizations in general or securitizations for insurance companies as an investment, please do not hesitate to reach out to us. All our contact details are, like always, below in the properties of this channel. Thank you very much.
Thank you, Martin.
And see you soon. Bye-bye.
Bye-bye.